Greetings, diners, and the rest of you collapseniks out there. Today we're doing the Shit Hits the Fan special broadcast of the Collapse Cafe. This has been a watershed week in collapse-oriented topics. We've had a collapse of the stock market. The Dow is down something like 880 points in the last 2 days. In addition to that, the Saudi market today was down 7%. The oil price for this week dropped below a $40 handle for the first time since I think it's 2009. We had two major explosions in Chinese warehouses or factories this week. There are numerous currency problems going on with the emerging markets and many smaller currencies, subsidiary currencies to the dollar. All in all, there's a lot of stuff going on. We did not know this was going to happen when we planned this this vidcast. I did a vidcast a few weeks ago with Nicole and Arul from The Automatic Earth, and we had great response on that. And I said, well, let's follow this up with another video cast, and let me see who else I can get. And it turns out I was able to get just about all of my friends from the Collapse blogosphere. And just to introduce you folks to the people who are here, who don't necessarily know who they all are, starting, I think, from the left of your screen is Hugo Barty. Hugo runs the blog Resource Crisis, and he is a professor of physical chemistry at the University of Firenze in Italy, and is my long-lost twin brother. After him is Tom Lewis. Tom runs the blog Daily Impact, and he was a long-time environmental journalist. Also was, I believe, president of the Civil War Society, so he knows a good deal about history. And after him is Steve Ludlum. Steve is a professional photographer, and he runs the blog Economic Undertow as well. He's been writing on economics for a long time, and I've been haunting his website and annoying him for almost that whole time. After him is Norman Paget. Norman wrote the book The End of More, which covers basically the history of the age of oil and actually the whole fossil fuel economy, starting with coal. Covers topics in population overshoot and many of the other things that we're concerned with. It's available on Amazon.com if you want to go buy it. After Norman is Nicole Foss. Nicole was, I believe, an editor on the Oil Drum while it was still functioning, and she also migrated from there with her partner in crime, Roel Aylargi-Meyer, and I finally got the pronunciation on that correct, to The Automatic Earth, and The Automatic Earth is one of the most popular blogs. Nicole also wrote a tremendous tome recently on what she calls solution space, and it's a marvelous piece of writing. It was great work, Nicole. After that is my partner in crime, one of the admins on the Doomstead Diner with me. His handle is Munsta. We use handles rather than names on the diner. And resides in England. He's in retail banking, besides being the diner admin and my co-host on these things. And last but not least, Gail Tverbert. Gail's a former actuary, and she runs the blog Finite World, and has been a long-time activist in the areas of peak oil and resource depletion, that sort of business. She also, I think, was an editor on the Oil Drum prior to our Finite World. So that's the crew here today, and we will be breaking up our vidcast here into parts. We have various topics that we're going to consider here because there's so much going on. And getting all these people together at once is probably a once-in-a-lifetime opportunity. So we're going to try to get as much done as we can. But we are going to break up into parts. There will be short intermissions between each of the parts that we're doing here today. And our first one is going to be on the energy industry and what's going on with energy. And I'm going to turn over the moderating ranks or moderating responsibilities now in terms of questioning and figuring out who's talking next and all the rest of that to my partner, Monsta, and I will take off my moderator hat and put on the pundit hat. So, Monsta, take it away.
All right, thanks for that intro, Ari. And in this segment, we will look at the various effects of the ongoing price collapse in the energy industries. Specifically, we will look at coal and oil prices and what effects this will have on the producers and the consumers in the various markets. And one of the biggest effects that I've seen in this collapse in commodity prices through all the sectors, and one of the things that is most interesting is the collapse in oil prices. And since collapse is used in so many places for the production of electricity and is leading to a situation where coal production has become uncompetitive and various coal mining and coal production companies are facing bankruptcy. Now I'm just wondering, how will this affect electricity production as we move along here? I mean, just to elaborate, you don't have to be specific to just the global thing. You can talk about the US or China or whatever region that you're most knowledgeable in. So I was just wondering, Gail, what is your feeling about coal prices? Are they going to be low or are they going to rise, and what impact that's going to have on the general economies going forward?
Well, the way I see it is that worldwide we have a problem with too little purchasing power, getting back to the workers. And this is it's the way the whole economy is working. The economic pump, so to speak, is failing. And so what we're seeing this work out in all commodity prices. We're seeing oil prices too low, we're seeing natural gas prices too low, we're seeing coal prices too low, we're seeing food prices too low, and metal prices are quite low. And I see the prices continuing to stay low. So what's happening in the coal industry is that there have been quite a number of bankruptcies. I wrote down a few here. Patriot Coal, Walter Energy, Alpha Natural Resources, Zenergy, and Arch Coal has not gone bankrupt as far as I know, but it's having difficulties too. When you look at the prices of coal stocks, what one index I saw said that since 2001, the prices of the stocks are down 89%. You know, the coal industry is doing terribly, and at the same time, coal is pretty much as essential to the economy as oil. But people don't understand that both coal and oil are essential. And we have a group that is behind peak oil, but there's no advocacy group for coal saying, look, if we don't have a cheap energy source, the economy just doesn't function properly. So I see this coal low price problem staying in there, but it may very well affect what electricity companies can do. They may find that they have contracts that they have made with companies, the companies go bankrupt, and then there's a problem of trying to get things reestablished. You know, is there going to be a new owner? How can they get something done? It's going to be one of those things we're going to have to work out, but I think it should be a concern going forward.
And what are your views about coal production, Nicole? how do you feel things are going to go, like in America or in China or wherever?
Well, I think production is going to fall a long way. What happens in a period of deflation, which is what we're moving into at the moment, as Gail said, there's far too little purchasing power. Demand is not what you want. Demand is what you can pay for. And in a situation where we're starting to see the money supply contract on a huge pancaking of the credit pyramid, what we're going to see is prices fall across the board, and we already are. Prices move with the ebb and flow of liquidity in highly financialized sectors. And so when you financialize a sector, the real economy, you introduce boom and bust dynamics. And what we had for a long time was a situation where the markets were pricing in scarcity rents, and so we had huge movements upwards that got ahead of the fundamentals. And when you do that, eventually you reach a point where the whole thing goes into reverse, and then you get an undershoot. So you get a very, very sharp contraction. And what we're going to be seeing is commodity prices in general going down to at least the cost of the lowest price producer, possibly even temporarily below that. So I think it's going to cause a tremendous problems. We've got demand that I think is going to be falling simply because purchasing power won't be available to support it. What that leaves you with is a supply glut temporarily, because the production is geared to the previous level of demand. Demand falls, and you end up with a temporary period of glut. So prices go down a very long way. But what this sets you up for, although it buys you time in terms of resources, you don't use them as rapidly, it sets you up for a supply collapse because nobody invests for years and years and years. You get production going out of, things going out of production, and those can't necessarily be brought back if the economy starts to create more demand again. So you set yourself up for a supply collapse, and I think we're seeing that in coal, we're seeing it in oil, we're going to see it across the board. And it's going to be part of the overall deflationary dynamic that we're moving into. It is going to be important for electricity. People think at the moment that there are going to be other things that we're going to have providing baseload electricity. I would argue that there are huge problems with all of them. So I think we're going to see problems maintaining power grids and things going forward as well.
So I was just wondering, though, because you mentioned that there'd be a reduced level of investment going forward, and then that would subsequently lead to a decline in supply. How long is this lag period? I know it's just, it's just guesswork, but do you have any time scales in mind when it comes to coal?
Not specifically for coal. I'm just simply thinking that things that are not going to be developed that would have been developed, and things that are producing but are producing at too high a cost will be abandoned. So it depends how long it takes for things to degrade, for infrastructure not to function anymore, so that you can't bring it back online if you need to. But I think a lot of things are going to be taken out of production quite quickly because they're going to be above the prevailing price. And then the investment after that will be, a lack of investment in new supply, a lack of investment in maintenance, and all of that takes a much longer time to have an impact. But I think at the point where we start to see anything that looks like an economic recovery, and it won't really be worthy of the word economic recovery in anything remotely like our current terms, but once we start to see a bottom and things picking up again, which could easily be a decade, it could be longer, then I think we're going to start hitting supply ceilings, very hard supply ceilings, because there won't be the level of supply that there is now, or anything remotely approaching it.
Yeah, it's a tricky one. Like it does seem to lead to a lot of problems. What are your thoughts, Ari, on these declining prices? How do you see things going on?
Well, there's a lot of knock-on effects that occur here as the time goes by. I guess coal is used primarily in China, right, as their main source of electricity production. And so the fact that coal is decreasing in its consumption means that China is also producing less electricity as a result, which means that China's factories are going to be producing less. All of those things are knock-on effects. So going over to Australia, Oz, China is a primary driver of their economy, buying their mineral resources, their coal and other things. So as coal consumption in China goes down, so goes down the Australian economy with it. It's very dependent upon selling that material. The fact that you have overall electricity consumption decrease means that then you have overall production decreases all across the board. And then what Nicole spoke about earlier, you know, it's a question of trying to get this back online later. If at some point, in some mythical way, demand could be re-stimulated for the stuff, money could be provided to people to actually start buying and consuming again, then, you know, where are we at with the oil industry? Because, you know, in order to mine all that coal, you need petroleum. All of the equipment, the heavy equipment used to mine coal is petroleum-based stuff, diesel and so forth, and it really can't be substituted for. So once the production levels in coal really go on a decline, it is highly unlikely that they can ever be brought up to anywhere near what their current levels are. And then without the coal, without that energy source, it's unlikely that we will ever be able to produce as much electricity as we're doing now in per capita electricity. And, you know, if you look at Richard Duncan's material and so forth, the blackouts and so forth that are likely to be coming down the pipe, those are all knock-on effects also of, you know, a declining coal price and declining coal mining.
And is there anything you wanted to share with us, Steve?
Well, one other factor here, first of all, thanks for having me here. I feel honored. You know, all the climate people are ganging up on coal, and they have really good arguments. In places like China and India, the pollution is life-threatening, and you know, they're taking steps to try to cut down on some of the coal, at least in the big cities. In the United States, there's a lot of public pressure to get, you know, switch from coal to natural gas, which is cheap. So, you know, as coal is becoming unfashionable, and when something becomes unfashionable, people don't want to have much to do with it. So, you know, that's affecting the price too. It's certainly affecting demand. So, you know, I read somewhere that the Chinese actually they reduced their use of coal last month. So it's been pretty much an escalator going up, and you know, that's definitely a component to it, particularly in climate change. People should really use no coal at all, you know, to keep the current temperatures at the level that, you know, near where they are right now. So there's a definite impulse in society to cut as low as possible the use of coal.
Yeah, I definitely agree there. I mean, I think in many places, coal is seen as a politically unacceptable solution to increasing electrical production or any kind of production. Certainly in the United States and Europe, it's not seen as a big thing, and it's hard for me to imagine that they could subsidize coal more to provide incentives to increase production. But I was just wondering, does anyone have thoughts on carbon sequestration? You know, like, is that a viable option? I mean, you know, it's something that I've talked about the last few years, but it's, as from my understanding, it's not so viable. What are your thoughts on, you know, limiting the amount of carbon released from coal production. What do you have any thoughts on that, Gail? Did Gail not hear me?
Gail forgot to unmute her mic.
Mike.
Excuse me. I was very good about muting my mic, but now I need to come back.
Now you need to remember to unmute.
When I first went to a conference talking about electricity, and they were talking about carbon sequestration, I heard all of the experts who were doing research on carbon sequestration going through a whole litany of all of the things that there were problems, the many, many, many different areas. You know, it's everything from raising the cost, using up the coal quicker, to, you know, can we keep it down there? Then how do you handle all of the property rights? How does the CO2 that you've put underground, does it cause chemical changes that are a problem? You know, so there's so many different things. I think it's something we should have figured out, you know, before we even spent an hour or two of research, that it's not going to work. It's just going to raise costs so terribly much, it's not going to be really affordable either. So we should not have pursued this to the extent we have.
Do you have did you want to add to that, Norman?
Yeah, I'm just trying to figure out how to come in on this.
You're on, Norman.
You're on.
Am I on?
You're on.
All right. As I understand it, it costs about 1.5 times the value of energy to take the carbon out. In other words, for every unit of energy you extract the carbon from, a unit of energy of coal, it costs you half as much again in energy to take it out. That's the way I've read up on it and seen it. That it costs more in energy to do it than the energy that you're actually burning in the coal itself.
Yeah.
Energy returned on energy invested.
Yeah, it is exactly. It's energy return on energy invested. So you're spending, you're using more energy to take the carbon out than you're gaining in the first place.
There is, of course, one.
They may improve that, but it doesn't seem like it at the moment. There doesn't seem to be any sequestration method available to actually do it at an economical rate.
Well, except for one method, which is pretty foolproof, and that's to simply not burn the coal.
Well, yes, of course, not burn the coal.
We're increasingly getting into a situation, it seems to me, in these matters where we have two competing sentences: the unstoppable object and the immovable rock. One statement is we have to have coal. Because we have to have electricity, and so there you are. And the other statement is, if we burn the coal that's in the ground now, we're going to incinerate the planet because of accelerated climate change. And we make those two statements and then we stop. Somebody's going to have to give up something, either the planet or the electricity. I mean, it's just logic. The other thing I'd like to point out, I live in West Virginia, and coal's political here. And they may be going bankrupt left and right, and the kingpin of West Virginia coal is facing a prison term for 29 minor deaths at the moment, but nevertheless, they're raining money on politicians and maintaining the fiction of Obama's war on coal. In West Virginia, this is all Obama's fault. This is all the dastardly Environmental Protection Agency conducting a war on coal. Now, this is silly, but on the other hand, it demonstrates, I think, what we're going to see as the end game of some of these industrial extractors of coal and oil. They're going to find, as we all like to do, someone to blame, and in the case of the big oil companies and the coal companies, they have a great deal of money with which to assign that blame, and they're going to use it freely. So here we have this coal industry in crisis, lavishing money on people to establish the notion that it's Obama's fault. And its behavior, I think, we'll see more of in the near future.
I think it has to be someone's fault. That is the whole. You've hit it neatly there. It has to be someone's fault. Someone has to be, some individual, preferably, has to be to blame. And the president's in the firing line, I think, at the moment, and the EPA, of course.
Yeah, there's always a blame to be had when the problems happen, and that's the thing, and I'm sure there'll be a lot of it, and it can even get violent if things get bad enough. So, I mean, personally, with me, I think coal sequestration is a bit of a non-starter. Two reasons for that. Already mentioned is the energy return on energy invested. It doesn't seem practical. That's my understanding. And then second of all, if you have an environment which is deflationary or otherwise low price, it just doesn't make sense to invest that amount. I think it would get abandoned before the idea gets started. So that's my thoughts. Anyway, just to go to another energy segment and concentrate on the oil industry, I think that, at least personally to me, one of the big surprises was the price collapse that came towards the end of 2014. Now, to many, not all, I know certain people, Steve in particular, saw this one coming, but to a lot of people it was unforeseen. And in fact, there were many people in the peak oil community who believed that oil prices would just carry on going up. And there's been a few that argue because of credit constraints and so forth that this would go down at some point. And even Steve in particular, he mentioned his infamous triangle of doom to demonstrate this. Steve, I was just wondering, can you just elaborate on this triangle and how it works exactly and what points you try to get across here?
Okay, well, basically it's an observation. It's not really abstract. And if you can look at it closely here, this is one that I did back in 2012. Basically, it notices that when the oil price gets high enough, there's some kind of a problem in the world economy someplace, and what happens after that is the oil price goes back down. And this is something that happens after energy crisis. It happened in '73 and 1980 and a few other times. And the assumption behind all this is that the oil price has to be really, really high before there's the economic consequences. The standard economic approach is that prices are inelastic and demand is sticky, and people are going to pay whatever they have to. But they have to have the money in order to pay. And money in the West is borrowed. All money is borrowed. And if they can't borrow, then the effect is the same as if they have rationing cards. So what we have is a highly financialized system that rations access to fuel by rationing access to credit. So all the times that we've had, this is more recent, where the oil price will go up and then it'll plunge back down, and it'll go up again. Trying to get the price up is the industry's attempt to meet its expenses, generate some cash flow so it doesn't go broke. And at the same time, the price gets high, less high with the passage of time. You can actually see the trend and see where the trends intersect, and that's what, when you get to the point there, that's someplace where you don't want to be. And when you get there, the price can't really go up any higher. The price will go down because of credit constraints. So, what started happening last summer, if you can remember last summer, you had the war in Ukraine, we had the war in Syria, we had fighting in Libya, we had fighting in Iraq, it's terrorism all over the Middle East. And, usually when you have military problems, particularly saber rattling, or Israel versus Iran, the price will go up. And you see the price starting to go down. So it was a phase that started last summer. The world's most important commodity couldn't generate a bid. So that meant that out there in the greater world, the marginal customers are being excluded from credit. And what we're seeing right now is a consequence of that, that transition. And we're in an entirely different situation right now. It's very serious because the trend has really changed. And it's, I'm afraid that things are happening really fast, and people just aren't paying attention to it. And particularly people in charge who should know better. They are, assuming that this is just a marketplace problem and it's a shakeout of weaker hands, and everything's going to get back to normal. Prices go back up, and the credit system is really breaking down fast. It's not just in the oil markets, in all these other markets. And once the credit is gone, you can't just simply reconstitute it. I mean, the credit providers around the world, particularly Wall Street and the City of London, are cranking out their credit as much as they possibly can. And if they can't get a bid on some of these important things, doing the best they can, they're not going to get a bid if they're bankrupt or they're out of business. So that's really the situation we find ourselves in right now, where we have energy deflation and kind of a race for hard currency. The hardest, of course, being the dollar, and something like gold maybe, but it's definitely the dollar at this point. And once these dynamics take hold, then we're in trouble because we can't get out. And we can see the price going down, the entire credit being stripped out of the oil market, so that what pays is what you can pay for is what you can actually get a return. And most of our petroleum uses has no return; it's just entertainment. So actual return is probably a negative number. So you can see the price actually go down to near zero. And at that point, you wouldn't have any petroleum because all your drillers would be out of business. So that's kind of what we're looking at, in my opinion.
Yeah. I mean,
let me break in on that one a little bit. Price near zero. I don't know how many of you guys are aware of B.W. Hill's report, the Hills report, which did a thermodynamic analysis of the price versus energy return on oil. And basically he came up with a price of $20 per barrel by 2020. And at that point, the price would be so low that the industry would essentially be done because there would be no profit in pulling the oil up out of the ground anymore. So I'm curious as to how anybody else sees that, and not just that report, but that prediction that that probably the amount of time that is left for the oil industry to continue on in some sort of profitable manner is a 2020 limit. Anybody else have thoughts on that?
Marie, it's not really profitable now. It's some of the low-cost producers actually get a cash flow return, but you look where oil is coming from now. Even the low-cost producers are having to work over their field. You have tertiary extraction methods like water flooding, steam flooding, and nitrogen flooding, and solvent injections, and all this. They drill in between the existing wells. They try to get the last drop of oily water out, and all that needs more processing. And it's in faraway places where transportation is a real problem. And they're underwater. What holds them up is access to junk bond financing, and they get to the bond market, and they sell shares, and it's basically financialization of the whole process. So if they had to rely on cash flow, I'd say 90% of them would have to close their doors right now. Yeah, but that's true. I mean, ultimately, it's an industrial enterprise. Industrial enterprises are by nature, they're underwater. They need credit. No credit, no industry.
Yeah.
So
I mean, the thing I see here is the price of oil has to sort of fall into a Goldilocks range, as it were. It can't be too high for the consumers to find it's unaffordable, but it can't be too low to send the producers out of business. That's the basic problem. And generally speaking, I think those margins seem to get smaller as we go forward because the production costs go up. The affordability generally gets less if incomes are stagnant or declining in real terms, I'm talking about. So that's how I see the basic gist of this problem. But how do you see this dynamic going forward, Gail? Like, how is your views on the oil?
Well, I think we could think of it in terms of, remember in the second half of 2008, the price of oil dropped very low. It was actually below $30 a barrel. And at that time, that's when the U.S. put in quantitative easing. That's when China went into all of its big increase in its debt to try to pump up the world economy. So we have been having this whole set of debt and more debt and more debt to pump up the economy. Now the U.S. is tailing off stopped its quantitative easing, and China has said, well, we can't keep pumping up our debt all that much, partly because we've maxed out on the number of factories we need for certain things. So what happens is that without all of this additional debt, the price goes in the toilet. And so this is the problem we're having, and we're not getting the wage growth either. There's two ways you can pay for your oil. It's either with more debt or with more wages, but median wages have not been doing very much, at least in the developed countries. Maybe in China they've done better, but the workers can't afford to buy new houses. You get the interest rates as low as you can, but they still can't afford them. It's just the well-to-do. And at the same time, we have people spending more on education and on health, and these things take away from their ability to buy homes and cars and things that use commodities. So I see that we're already at a point where we cannot afford the oil, and it's kind of stuck down here, and I don't see that there's a need to project to 2020 for this.
And it does seem like these oil prices will remain depressed, and the only thing I would sort of say to that is with the low oil prices, you get less investment, and then you get a decline in total oil production. You're already seeing a decline in production in the Bakken, for example, which is very highly capital intensive and requires a lot of credit. So my argument to that would be that if the production goes down, then assuming demand destruction isn't as fast as price declines, you're going to probably get an increase in price at some point. That's my feeling.
Well, I think the thing that people don't think about is that we have banks that are affected. We're going to have a lot of debt defaults, partly from Bakken oil companies and from a whole series of others. I'm thinking about the international debt, where people have borrowed money in loans that are denominated in U.S. dollars, but their currency is now a whole lot lower, and they're going to have trouble paying it back. So it's going to be a lot of debt defaults. When you get those debt defaults, then the banks have problems. And the current idea of what they want to do with that is to have haircuts to depositors' balances so that the banks don't fail, and you don't have to print a whole lot more money to try to bail the banks out. Well, the problem with that is it's deflationary. If people don't have money in their bank accounts, they can't buy anything, and it makes our deflation problem worse, not better.
That is true. I mean, I did hear an article today about Chinese pension funds will be allowed to be pumped into the stock market for the first time, and I think that's just to plug the gaps. And question mark there is, will that just lead to, is it just good money chasing after bad money? That's the big question. And if it is, then that could be quite deflationary in itself. So yeah, that's a possibility that I could see happening in the future. What's your views on this, Nicole?
Well, what we've lived through over the last 30 years is really a monetary supernova. The extent of the financialization, the extent of the bubble is absolutely staggering. It's the largest one in human history. What happens when you have a massive bubble is you get an artificial stimulation of demand. You borrow demand from the future, essentially. So you bring forward demand. You have an enormous blowout of the demand and then the development of the supply to service that demand. You're borrowing a huge amount of economic activity from the future. That's what we did. That's why we had this enormous degree of demand. And what it does is it creates malinvestment in an attempt to supply that demand. So you had development of incredibly low EROI energy sources that, well, essentially they produce no energy at all. The reason that they exist is they produce money. We've over-financialized the sector. There are a lot of subsidies. There's real estate Ponzi schemes as people flip land leases. In the gas sector, for instance, they were making money flipping land leases while losing money on every unit of gas they produced and borrowing money to stay in the game to do it, so digging themselves in an even deeper hole. The extent of the malinvestment is absolutely staggering. If you look at things like oil sands or all of this unconventional oil and gas, this is such a ridiculous thing to do with capital. The depletion rates are incredibly fast. The energy profit ratio is incredibly low. It's scarcely above 1. Sometimes it's not above 1. And the comparison that I like to use when people say, oh, well, we're going to have all this unconventional oil and gas in the future, I say, well, to compare the two, conventional oil and gas are like you're thirsty, you go up to the bar and you get another beer and you sit there and you drink it in comfort. In comparison, unconventional oil and gas is what you do when you can't get another beer from the bar because it's closed, so you're still desperate, so you suck spilled beer out of the carpet. So you end up with a huge amount of effort for almost no return. It's a horrible experience. You get a mouthful of dirt, and it's in no way a substitute for what you can no longer have. So what we have created in our monetary supernova is this situation where we've put a huge amount of money into accomplishing absolutely nothing extremely expensively, or nothing good, but all sorts of things that are bad in terms of environmental destruction and climate issues. We've produced a horrendous impact for no energy gain essentially whatsoever. And all of this is also extremely expensive to produce. So all of that is going to go away. What happens when you hit the wall is you suddenly realize the extent of the malinvestment. So as John Stuart Mill said, it's not the panic that destroys the capital. The panic merely reveals the extent to which capital has already been destroyed by its betrayal into hopelessly unproductive works. And that's exactly what we've seen in the oil sector. All of it is going to go away. All that unconventional oil and gas, the fracking, the horizontal drilling, all the low energy profit ratio stuff is just gone. We're going to see prices come down to the lowest cost producer. My long-term guess is about $20 a barrel, but that is a guess. It's not projected on an in-depth quantitative study. It's simply my view of what's likely to happen to prices. I don't think it'll take till 2020 to get there. The one caveat that I would mention, though, is when we think in terms of oil at $20 a barrel, we think cheap oil. But at the point where oil would be $20 a barrel, $20 might actually be a lot of money. In a deflationary scenario, the value of cash goes up. So what you end up with is prices falling, but purchasing power falls faster than price, meaning that prices are rising in real terms. Affordability is getting worse even as prices fall. And that's exactly what I think we're going to see. So prices absolutely cratering and purchasing power falling incredibly quickly. The cost of production will come down less quickly than purchasing power will fall, meaning that it's just going to suck investment out of the sector faster and faster and faster on the way down. So I don't think we're going to see any new investment for years, possibly a long period of time. And exactly the same as I said with coal, I think we're going to see our demand collapse set us up for a supply collapse. So we're not going to have the investment if the economy tries to recover at some point, and recover being relative, but if the economy tries to recover, it's going to hit a hard ceiling at a much lower level of energy supply. We're not going to be able to sustain the level of socioeconomic complexity that we currently have. And the argument that I've made many times before is all these extremely complex low energy profit ratio energy sources are incapable of supporting a level of socioeconomic complexity required to produce them. So they are not the future. They're not the present, and they're not going to be the future, because in a simpler future we won't be doing any of those things.
No, I definitely agree. In the long term, it's not going to have much of a future, but I'm sure everything will be done to make this viable venture. Bailouts come to mind, cheaper credit, and so forth. What do you feel about this whole situation, Tom? Do you see any future in the oil, or do you basically agree with what's just been said so far?
Well, I do agree with everything that's been said so far, but only add this. I think it would be useful to remember that the crash in oil prices is not the entire cause of the effects that we're seeing. The production from the fracking wells in the Bakken and in Texas is starting to crash, and would have crashed if prices had stayed at $100 a barrel. They were marking a technical profit at that price, but they were cash flow negative while they were getting $100 a barrel. The entire patch was. They were going into heavy debt to keep going because of those staggering depletion rates. They only get about 3 years out of a well when they're fracking. And the end of the so-called revolution in the United States was in sight before the prices crashed. There are other things that are coming into play. The Alaska pipeline is in hospice care right now. They can barely keep that thing going with 40% of the oil that once went into it. It's beginning to freeze up. Somebody said it's on the verge of becoming a 1,000-mile-long popsicle, and that's likely to take the Prudhoe Bay oil fields out of production, out of being any use to us, much ahead of schedule. All kinds of things threaten the supply. So this commodity that is very, very cheap right now is also on the verge of becoming very, very scarce. Now, whether or not prices suddenly go up again when that's realized, or when the first contract cannot be filled because the supplier simply doesn't have the crude oil, what the price does to me is almost irrelevant. The fact is we'll be out of oil, and that's when the stuff hits the fan.
Yeah, I think you're definitely right about production declining in the unconventional oil quite soon. I mean, I remember reading an article, I think it said it was from the EIA, and it was projecting a peak in shale production in 2017, 2018, something like that. And that was for when oil was at...
Can I just add this?
Yeah.
I'd like to add one thing. We sort of knew this was coming for the unconventional oil patch, but some of us have noticed that the majors have stopped spending CAPEX, capital exploration, capital expenditures for exploration of new fields, because they can't find any. They went through 3 or 4 years of extraordinary expenditures looking for new sources of oil, and they didn't find any. In the last couple of years, they've been cutting back on CAPEX dramatically, which means, as one observer put it, they're in liquidation. When you're not finding as much new oil sources as you're consuming, you are in liquidation. That applies to Exxon today.
Yeah, it's the reserve replacement problem, isn't it? And it only gets harder over time. So it's difficult to see a good scenario there. Although saying that, if you look at the mainstream media, there's a lot of people out there, John Moulton is one, and they always make the general argument that drilling is becoming more efficient, it's becoming cheaper to frack, and so on. And this will reduce the costs of oil production and make the industry viable for a bit longer, and keep everyone solvent. How what do you think of that kind of dynamic? How do you feel? How much truth is there to that? Do you want to fill us in on this, Steve? Or?
Well, there's no, well, let's say there's dueling narratives. The media narrative, John Malden's narrative, is right out of the Bloomberg, the Wall Street Journal, and New York Times. They all pretty much say the same thing. It's a part of our progress narrative. Where all these things are getting better tomorrow. We're going to have more. We have unlimited supply of resources, and all we need is plenty of customers to burn stuff up. So that's on one hand. On the other hand, we got a few people on the fringe. Like to point out that most of the economists and business managers and politicians follow that narrative. They follow the cornucopian narrative. And then you have the few people on the fringe, such as a group we have here, they kind of look at evidence a different way and say, well, that's not really what's happening. First of all, we have a finite planet, and you can only get so much out of it. You have the energy input to get the stuff out, and then you got to deal with a system that's basically running amok, and it doesn't really function very well. And in other words, it does a bad job well. And the job really shouldn't be done at all. We shouldn't be piling on trillions of dollars worth of debt around the world because there's no way human labor can pay for it. So that's really the bottom line on that. So these narratives, it's the same thing with climate and militarization and a bunch of other things. It's like the establishment has a way of doing things, and it's incredibly self-destructive, and it's been hell-bent on following these narratives to a logical conclusion, which is like complete unraveling of their whole enterprise, what they really don't want to do. And so they've kind of stuck themselves, they painted themselves into a corner. You look at all these different subcomponents like central banks, political legislatures, different politicians, dictators, kings, they're all making the same stupid mistakes, assuming that the way things have been for the past 100 years are going to carry forward. We just have to get past this rough spot. And it's just a completely false way of thinking. It leads absolutely nowhere. Things are getting worse. The speed at which, I hate to use the word doom, it's approaching really fast, and we're stepping on the gas pedal, and it's really, I feel privileged to live in a time where I can watch all these people go nuts in public. I mean, that's basically what they're doing, and it's not only are they nuts, they're criminals. They steal everything that isn't nailed down, and then they brag about it in the newspaper. So, right now it doesn't look like there's any way out of it, but there's always tomorrow. There's the hope somebody might get smart and say, look, we got different. But it's two narratives, and they're clashing. Right now we haven't really figured them out yet. Maybe tomorrow we'll get a different. Maybe this conclave right here will change somebody's mind, critical person's mind.
Yeah, I mean, in all honesty, I think the prices, they could decline somewhat because of efficiency gains or whatnot, but I don't think it will decline sufficiently to make any material difference to the final outcome.
Look, here's the thing. Abraham, let me tell you something. My brother used to tell me all the time he was interested in real estate. He used to say, we got to buy real estate. The price will never go down because they're not making any more land. And I would tell them, well, they're not making any more people with money either. They have basically the same amount of purchasing power, and it gets divided up more and more people, more and more ways. And the lion's share of it goes to big companies. In fact, goes to the lenders themselves and their clients, who are a bunch of tycoons. And they don't. There isn't enough for the rest of us to support the price. And everybody has to borrow. This is a point I keep making over and over again. It's like there's no such thing as earning. There's no such thing as wages. A wage is somebody else borrowing something, borrowing money from a bank, and some of it's paid to you as a wage. So everything is borrowed money. So when the borrowing stops, which is what's happening right now, you have to get to actual returns, which are the equivalent of wages. And there's very few things on planet Earth that we do that actually provide a return. You know, like art makes a return, agriculture makes a return, artisanship, you know, kind of like cabinet making, things like that. You take something that doesn't work very much and make it into something valuable. Most things are just entertainment. It's time-wasting, fashionable BS. And in order to support it, you have to borrow. And when the borrowing's gone, there's nothing left. So there's no support for oil price. That's why the oil prices go all the way to zero, because there's no remunerative use. I'd say just the commercial use of petroleum is probably about 5%. And that would be things like construction, emergency vehicles, you know, hauling, you know, bus drivers and taxis, farm tractors and things like that. The rest of it is just people buying a car, driving around in circles from gas station to gas station, feeling good about themselves. And there's no return for that. They have to borrow. Somebody has to borrow in their name in order to pay for the gas, has to pay for the car, has to pay for the roads, has to pay for the factories that make the cars, it has to be paid for the government and for the insurance companies and the banks themselves. All these things, the military, you know, these things have turned into gigantic, inversely pyramidal organizations that are nothing but collections of costs. And it's all done with borrowed money. There's no earning power anywhere to it. You can't drive a car to pay for all this stuff. So when you can't pay for it, then you have to come up with an alternative regime in order to manage it. So, you know, if you're left to its own devices, there's no credit. There's no borrowing. There's no support for this stuff. All those assets become liabilities, and it becomes a gigantic, catastrophic mess, which is happening right now. I mean, you know, what Nicole has said, and she said it over and over, you know, once this stuff starts to unwind, then the leverage works the opposite way. And instead of benefiting, it becomes a real, you know, kick in the rear end. And, you know, it appears to be underway right now. I mean, in my opinion, that's what's happening. We're already, you know, you can't fix it monetarily. You can't.
All right, I'm going to break in here, Steve. We are coming to the end of this particular segment of our conversation, the energy segment. And I think for the most part, there's general agreement that we have a situation where the oil price is going to be constantly driven downward by purchasing power, one way or the other, and by the overall profitability or energy returned on energy invested that's possible. All of those things are going to make the oil industry and the energy industry in general non-remunerative, if you will, as time goes by here. So we'll leave that aspect of it for this conversation, and we're going to take about a 5-minute intermission, and we will be back with a conversation on what's going on with the economics of our current situation. So we hope you stay with us and on the Collapse Cafe channel, and we'll be back to join with you in a little bit. And that's all to do this segment until next segment here on the Collapse Cafe.